Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and policy impact. I'm Govindraj Ethiraj. In August last year, the Reserve Bank of India gave an in-principle approval to 11 entities to launch payment banks. Now, these banks were seen as an important step in expanding financial inclusion and the effort to move away from a cash economy. Now, these banks can take up to 100,000 rupees as deposits but cannot lend, and 25% of their branches must be in unbanked rural areas. However, in the last week, several entities, many of them business houses like Tech Mahindra, Cholamandalam and Dilip Sanghvi of Sun, had got licenses earlier but are now saying that they do not want to pursue this business. So why are these organizations pulling out of something that seemed quite lucrative a few months ago? Is there a fundamental business model challenges? What are the larger challenges then in building strong technology banking platforms as we look ahead? To discuss this, I'm joined by Atul Kanwar, President and CTO of Tech Mahindra, and Shailesh Pandey, Strategy Head and Executive Vice President of Fino Paytech. Gentlemen, thank you both for joining me. So first question, let me ask you, Atul, so why did Tech Mahindra get into this space and why did it pull out?
Well, our intent to get into this space was very clearly to demonstrate how technology can make a difference in terms of banking and making financial inclusion possible. So I think that was our key goal. The reason why we are not going forward with this is because we believe that in this intervening period, from our perspective, the business viability has become lesser. So it increases the period of payback, as well as it means that we have to devote more funds to it. And so it's a question of looking at which areas we want to put money in and which areas we want to grow across. It was a decision based on that.
Right. So what's changed in the intervening period?
So the opportunity remains.
Hardly less than a year.
Yeah, the opportunity remains. I think what really has changed is the way the opportunity is going to be addressed. So fundamentally, when the licenses came across, immediately after that, you also got the small bank licenses. There's also technology has moved really very fast in this whole period. So suddenly you're going to have even traditional banks, the public sector banks, the small banks and the payment banks all going after the same consumer. So effectively, you either have to have some kind of a big element of customer base, or you have to be able to do something which is uniquely different. On the technology front, whatever you bring around, in the next couple of months or couple of weeks, someone else can catch up.
Right.
So it is really about how much reach you have across. And for us, it's like starting afresh along with Mahindra Finance.
Right. So Shailesh, I'll just come to you in a second. But were you also fearing that you would have players who are, let's say, venture capital funded, who perhaps have no or much less regard for the way capital is used?
Which is true. So
and you have real shareholders. Yeah.
Absolutely. So I mean, in a way of speaking, I'm not saying one way or the other their strategy is valid for them, but from our perspective, it means that a lot more money is going to be put across to gain the consumers, as well as a lot of other policies are going to be there which are not in line with our business ethic or our business way kind of a thing.
Right.
So it was more from our perspective. So it's got nothing to do with the opportunity.
The way others are doing it, but the way your shareholders would react if you were to blow
the question is not about blowing. The question is that you need more funds to participate in this more actively, and we decided a more prudent way would be to say, okay, let's move on from here.
Right. So here's someone who is maybe imprudent. Tell me, Shailesh, so why is Fino going ahead with this? I know this fits in with broadly with what you've already been doing. You have a fairly large 29,000 agent network across the country, and you have business correspondents, and you've been in the space of financial inclusion for a long time.
So for us, it's a very natural progression. Our core business has been financial inclusion. We have been working with all the banks, all the insurance companies to promote financial inclusion, and we have acquired about close to 100 million customers in the last 10 years, along with 30,000 agent network which we have. So for us, what we have been doing, the payment bank actually strategically fits into that as a space. Also for us, we're not starting from scratch, which means we also believe that payment bank, the way the model has been structured, you should be able to leverage certain assets. So whether you leverage technology, whether you leverage people, whether you leverage distribution, whether you leverage the know-how of the consumer, it's important that you have that know-how in order to succeed in this business. And for us, it's not about putting capital somewhere else, because we've put capital only in this business for the last 10 years, and we'll continue capital.
So can you explain that a little more in terms of, let's say if I were a consumer of Fino traditionally, what would I have been using, or in terms of services, what would I have been using earlier, and how will a payments bank change that relationship potentially?
So we have been opening accounts for banks where customers can come to us, open accounts. Today we're doing on behalf of some other bank, tomorrow we'll do for ourselves. In that process, when the account is open, your DBT payments, your savings deposits which you can put in, withdraw, your money transfer, which is one of the biggest use case of payment banks, all those and the other revenue lines will develop as the payment ecosystem develops. They continue to do for us, and we have a profitable business model today in that space. So for us, it's an incremental. In fact, for us, it's better because once we are our own bank, the trust of the consumer is much stronger and the ability to convert will be much higher.
Right. So you're saying transferring payments, and I'm going to come to the what you can potentially earn from this, is an important leg of this. That the ability to receive, let's say, a direct benefit transfer and give it to a user or a consumer or a customer. Now, does a payment bank fundamentally change the economics in this?
The economics of this model is a small value, high volume transaction, right? So as Atul was rightly saying that, and if you don't have volumes, you'll not be sustained in this space. So scale is very critical because that's where technology as an enabler also helps in that space. So units of economics has to be from a cost perspective lower because the revenue are not as high as what other consumers typically will try to pay you.
Right.
So the spread will be a function of how you manage your cost as well as how do you scale up the revenue line.
Right. So let me ask you, Atul, in terms of fee income and versus, let's say, income on interest or net interest margins that any bank traditionally earns, was that a concern as well?
No, I don't think we had a question on the business model. Our angle was that to acquire those customers, if you do things which are beyond the business realm, then that becomes a challenge. It only means you have to fund it differently. So the core model does exist. Transactions will happen across. As a point to mention across here, effectively worldwide, and this is not just an India statistic, roughly about 8% of the world's money is really cash. The rest of it is actually digital. However, it doesn't transact that way. From a transaction perspective, more than 80% of the transactions are cash. And in India's case, it's even higher. So fundamentally moving that transaction onto electronic, like what Sweden has done, where the total cash transaction are less than
Almost
20%,
zero.
effectively. So it's the other way around. So there is an opportunity. Linked with that, the transaction fees may undergo a change, but nonetheless, the transaction numbers will increase very significantly. So that was not our consideration here at all. It was really a question of saying, how can we best participate in this space? And we thought, rather than being the bank ourselves, we may be able to support many of these banks across in different ways on the technology front, which is really a calling card.
Right. And is that something that you already have a service or a product line available?
So we actually invested fairly extensively in terms of building this entire capability as well as the direction that we're going to go across. We're definitely willing to share that and work with other people who are going into this realm and see if we can support them in a better way.
Right. So Shailesh, if we were to look forward, would you not face the same challenges of customer loss or acquisition by someone else because they're going to spend a huge amount of money, or conversely, would you also get drawn into this game?
See, I would say there are two very different, I would say, business models. One is where you have to service the, I would say, mass market or small customers which are there. There you require a very strong distribution chain, the physical leg, which is you require merchants, branches, because the assistance and touch is required very high because they are getting banked for the first time. So they unbank, underbank in that space. There we believe we have an edge because of the distribution leg and the technology and the know-how which we have in this space. I have my doubt if somebody would move very aggressively in this space because very different business model in that case. The second leg where I think there will be huge.
I think the question is, someone comes and just throws money at your 100 million customers, will they start pulling them?
So I'm saying it's very difficult because the unit economics are so low, for them to reduce that cost will be a challenge. But the other part, which is the digital transaction space, which is purely payments, my sense is which also affects us, where we do a small value transaction like booking a Ola, Uber in that space. That is where we believe there will be huge competition, and what we call it's a click model. The other one is more of a brick type of model. There is where you will see a very intense competition, leading to very high scale of transactions and subsequently reducing cost of transaction in that space. So there the burn rate will be very high, and we are very conscious that we will not be playing very aggressively in that space.
Okay. So from a regulatory policy point of view, Atul, I mean, now that you've studied this, and while you may have stepped away because of the cost of going after this opportunity, what are the other issues that could have been addressed which might have made it, or in future might make it a little more attractive?
So I think the Reserve Bank of India actually did a very good job in terms of trying to define what the goals were, inclusion and so on and so forth, electronic basis. All that was positive. I think the thing that really happened is something beyond what they comprehended, which is that technology became so pervasive that it went across all levels of banks. So everyone was starting to fight for the same consumer. So that is the only way they could have possibly, or the only way in which, if you think in retrospect, it could have been avoided, was if there was gaps between various things. So for instance, if these payment bank licenses would have come 12 months earlier, that's a different scenario, because then you'd get those 12 months. And if you really look at it in terms of how many people moved across because of a simple regulatory change that RBI did at one stage about two-stage authentication of credit cards, and on to things like Ola and Uber, so suddenly that whole wallet business got created.
Yeah. And the UPI has come, which may again kill many.
So it's really those kind of elements. So if at all it is there, it's a question of timing. But beyond that, this was something that was going to come down the line in any case. So they had no control over this.
Right, but that's a useful point. I mean, that you should keep ensure that regulation keeps pace with the expected march of technology.
Right. And keep it open in some form so that you can participate and do things, which they tried. But it's just that everyone got onto the runway almost at the same time. So there's this kind of jostling around that's going to happen across. So some people are going to jostle more and move forward. Some others are just going to be startup.
Right.
There'll be place for everyone, but nonetheless, it's a different world.
Right. So Shailesh, if you were to look ahead now, I mean, we've had some fairly ambitious targets for financial inclusions, including the Jan Dhan Yojana ambition. Now, what's your sense? I mean, what role could the payments bank play in this? What are the gaps still ahead to achieve the larger objectives that we've set out?
So if you look at Jan Dhan Yojana, primarily has done two objectives very well. Apart from giving accounts to the consumers, it has developed a habit of saving. So we have 37,000 crores of deposit which has happened in the last 12 months, which is quite a significant built up in that space. And second, it is enabling the electronic benefit transfer. So today there is an infrastructure which is available which you can ride upon in that space. So those are the two good points on that stuff. From a regulatory point of view, I would say, from an opportunity point of view, I would say that if you look at small finance bank, the only restriction they had was on that they can't give large credit. Otherwise, everything which a typical bank can be done. And payment bank is that credit was itself made zero, which itself reduces the opportunity. And further with restriction and liabilities is where I would say people got a little confused into that space. So my sense is any opening on that side will help us from a long-term perspective, and that will give more confidence with the consumer because explaining to the consumer that you can't go beyond 1 lakh, though he'll never go maybe once in a year or maybe he'll go twice in a year, he might still be very hesitant
okay, so you're saying one is that relax those limits, which in any case might happen. I mean, assuming other things
so they have a roadmap in that space, but it might get accelerated, my sense.
Okay, is there anything else on the policy front, particularly on the cost of doing business, on the profitability or even the viability that could be threatened or otherwise?
What has also we've seen that as guidelines have progressed, the guidelines have become more imposing from a traditional bank point of view. So you're required to give a card, you have a physical infrastructure and all those stuff. The more those guidelines come from a traditional bank, then the opportunity to innovate will get reduced. So I would say that the guidelines also needs to be differentiated from that perspective. It cannot be pick up an existing guideline and put that,
right?
Because a lot of innovations.
So don't lay stress on physical branches, for instance.
So that's they have done. They have actually a lot of innovations happened in guidelines, because today they say 25% access point. They didn't say 25% physical branches. So that is an innovation in itself. Such innovations more on the on the framework will help the model in the long run.
Right. Thank you both gentlemen for joining me. We need to go in for a break, but coming up on the other side, remittances from the Gulf have been falling. Is there something to be worried about in the longer term? That's after the break. Stay with us. Welcome back to Policy Watch. Remittances from the Middle East and the Gulf region add up to almost $36 billion annually as compared to total remittances into India of around $69 billion. Now, the remittances are an important contributor to India's foreign exchange reserves, current account deficit, and more importantly, a source of income for millions of families back home. With oil prices falling steadily in the last year and Gulf economies coming under pressure, remittances have been falling too, though very marginally for now. A new report from rating agency CRISIL, however, argues that the situation isn't as bad as it appears because imports from the Gulf Cooperation Council are falling too. Now, what does this mean? More importantly, to what extent should we be concerned about falling remittances and its impact on the socio-economic scenario, particularly on regions that benefit the most from it? To discuss this, I'm joined by DK Joshi, Chief Economist of CRISIL, and Indranil Pan, Chief Economist at IDFC. Gentlemen, thank you both for joining us. DK, let me begin with you. So let's understand the fall in remittances versus the way you've pointed out the fact that imports too have declined in the context of the larger picture of remittances.
Well, I think in the context of larger picture of remittances, India is likely to retain its #1 slot even in 2016 because, as the World Bank study pointed out, even though the remittances from Gulf region or GCC countries may slow down a little bit, it's very inelastic, by the way. It doesn't slow down that much. I think the elasticity with respect to oil price is only 0.1, which means if oil prices fall by 1%, the remittances will fall by 0.1%. But I think the larger point
That's
is...
it. So 47% slump in oil prices, but remittance is only down by 2.2%.
Yeah, that's right, that's right. So I think if you look at the larger picture is that half the remittances come from other regions, and those regions are expected to do a little better. So they would somewhat make up for the loss here. The key issue is that oil prices too low for too long is not a good news. I think as of now, many of the GCC countries have cushion, and they are like Saudi Arabia, etc.
Right.
But I think if oil prices remain too low for too long, the cushion will start disappearing. Even if they try to diversify, it's going to take time. So if I think oil moving up a little bit is in that sense a good news for
back to $50 and so on. So explain to us, what is the interplay between remittances and imports?
Well, I think it's the decline in import bill is phenomenal with GCC. Over the last 3 years, it has declined by 44 billion, and the remittances have fallen very little. Now, what happens when the oil prices go up? I think remittances won't go up that much. As I said, it's inelastic, but the trade deficit will start widening, and I think that is where the bigger risk is from the perspective of your current account deficit, from your perspective of your forex reserves. So I think that will eat into your and I think the other worrying part is that even though we have reduced our trade deficit with the world in general and with GCC in particular, with China it is expanding. So even if when oil prices, imagine a scenario where oil prices are rising, trade deficit with China is not going to reduce. It's only on an upturn.
Right.
Now GCC
because
is
mostly importing mobile phones.
It's going to shrink with it's going to actually expand with GCC. Now what happens is, I think, just to give you a dimension, the total if you look at the flow between GCC and India, the flow was minus 16 billion, which means 16 billion outflow from India towards GCC about 3 years back. Today it is 22 billion surplus. I mean, so that is.
What is the reason for this?
Reason is that because your oil oil bill has reduced, and that has led to the reduction of trade deficit by 44 billion, which is phenomenal. I mean.
Right. So it also shows you the extent to which we're dependent on the GCC for our oil imports.
That's right. That's right.
Okay, Indranil, let me come to you. What's your sense? I mean, when you look at India's foreign exchange reserves, the external situation, current account deficit, how comfortable are we or are we not, and what should we be concerned about?
I think the point that DK was making was right, and I definitely agree with him in the sense that as imports actually rise through the oil channel, we might not see a big jump in the remittances, no doubt, but the cushion on the remittances on the lower side would definitely be there. That's number one. The second point that he rightly made was that the GCC was about 50% of the overall remittances, and the rest, which is a relatively growing part of the world, a significant bit actually comes from the US, where we are expecting an uptick to happen in terms of the economic growth momentum. And those are rather bulky and more sort of meatier remittances than we talk about the smaller fragmented remittances that we possibly get from the UAE. So the overall point is that what I really sort of tend to remain worried is that exports might not actually climb up. The imports from the oil might climb up. The other thing that might also happen is that the 7th Pay Commission might provide an additional impetus for spending within the domestic economy, which basically means that there could be an increase in the non-oil, non-gold imports also to a certain extent. So that would worsen my trade balance relatively from say a 0.9 to 1% that we were looking at in FY16 to about a 1.3 to 1.5%, which is still not scary. The bigger sort of ramification would possibly be on the capital account side, where there is hesitancy from the FPIs to invest into emerging markets, also in India, mostly or both on the equity and the debt side. The ECB has not been picking up. The short-term trade credit flows have been weak. The only hope is the FDI, which has been strong in FY16. So I think the overall sort of ramifications in terms of the overall balance is more riskier from the capital account side rather than the current account side.
Right. Right. So, DK, two questions now. So, first is that, countries like Saudi Arabia for the first time are saying that they're going to restructure their economies and are already begun doing it. They're saying we want more locals to go back and start working. We want to reduce subsidies. Now, all this is going to have an impact, number one. Number two, even as things stand, what is the impact of this on regions like Kerala, where clearly a large part of state income actually comes from remittances?
Well, I think if GCC is going to diversify itself away from oil, it doesn't mean that it won't create infrastructure. It will do it in a different manner, and I think so.
But you think they have fundamentally the funds or the cushion of funds that they had earlier?
No, I think
like Saudi Arabia.
Well, I think if the cushion is obviously coming down, I mean, but as oil prices have also moved up from their lows, and I think so. In a sense, I think the remittance part will not get very, very drastically impacted.
Right.
I think the one of the difference between remittances from GCC and the remittance from other advanced economies is that these are worker remittances. A lot of poor people go there and work. So I think GCC, it's more sensitive from a social perspective. It's not only Kerala, it's also UP. A lot of people are going from there. So I think as of now, there's nothing to fret. I mean, but you need to be watchful. I mean, as to what kind of developments take place. And there are geopolitical risks. There's an interplay of many things going on in the
right, but you're fundamentally saying that even if these economies transition from oil to non-oil, as some parts of the GCC already have, that is unlikely to have a significant impact on expatriate workers.
Doesn't look like, I mean, as of now, I mean, it doesn't look like that it's going to displace them, or maybe the nature of work might change.
Right.
But it's not going to be. It's not going to hit, at least not in the next 2 to 3 years.
Right. So remittances is one part. I mean, we've talked about GCC being half of the total remittances. What about our overall import bill today, and how much are we spending? How does this contrast with what we are likely to earn in terms of exports and our overall?
Well, I think overall trade deficit has narrowed down because exports have fallen. That's what is very clearly visible.
Yeah.
But
more than 17 months decline now. Yeah.
But I think imports have fallen at an even faster rate, and it's not only because of the price effect. It's also the volumes have fallen. I think the point is that imports, we are. I mean, if you look at China, we continue to import consumer goods. We'll have dependence on capital goods imports as well. We'll need to import oil. So I think these are more or less sticky kind of import items. Now I think going ahead, how much of Make in India can substitute for some of the stuff that we are importing, I think that time will tell. But I think you need to be far more competitive than you are today if you want to do that.
Right. So Indranil, two questions. I mean, your views on what the impact of potential falling remittances could be, particularly from a socio-economic point of view, and on some regions in India maybe more than the others. And secondly, your sense on the comfort on the external front going forward.
I'll take the second question first, easier for me maybe. In terms of the external highlights, I have already sort of analyzed that to a certain extent. But I think the overall implication for the external sector, if you are really looking at the value of the rupee against the dollar, would possibly more depend on risk-off phenomena in the global atmosphere rather than anything else. So from that perspective, I think I would still sort of see some risks of China in terms of a slowdown factor, which necessarily means that there could be ramifications for the global financial markets out of China. Brexit is something that we cannot rule out, and going forward, we would definitely have the US elections playing its part in the overall scheme of things. So I would not still believe that the world is a safe place to live in, which necessarily means that there has to be some pressure on the emerging market currencies on the depreciation side, and that is where Indian currency would go. On the other hand, of course, we have an adequate buffer in terms of the forex flows. What really needs to be tracked at this point in time is the type of FCNR outflows, or put in another way, what is the type of the FCNR outflows that were supposed to be happening can be retained back within India, which would provide the relative comfort in terms of the overall balance of payments and hence the stability from the external front, so to say. On the socio-economic front, I think I'll take DK's point up front, in the sense that there are definitely some typical regions whereby Kerala is an oft-heard name in terms of the immigration that happens to the Gulf region, and they are mostly poor people, and most of the reports that seem is that a significant amount of subsistence back domestically in terms of either their livelihood or children's educational expenses are borne out of the incomes of these people, which is relatively larger if they are working abroad. So some of these socio-economic factors in India needs to be sort of carefully analyzed, that there could be a bump down in terms of the socio-economic factors for India. But having said that, I think the current government, in terms of its overall sort of expenditures towards infrastructure and other areas in the rural segment also would possibly help to a certain extent over the longer term, possibly be able to minimize the socio-economic impact of these remittance flows.
Indranil, DK, we've run out of time completely. Thank you both for joining me on Policy Watch. We'll be back next week, same time. Thanks for watching.